All right. We are live. Jamie Lane, welcome.
Hey, Luke. Excited to be here. We've got a lot of people coming into the room right now.
We have a record-breaking number of people signed up for this webinar today. I think people want to know where the best places to invest are for 2026, Jamie.
Yeah, me included.
Yeah. Well, speaking of, as we let people funnel in here for the next minute or so, something we'll talk about later, something we released earlier this year was being able to filter by demand drivers, one of my favorite new features we have going. So my question for you, Jamie Lane, is which demand driver is your favorite for investment?
Yeah. So, as you mentioned, we do have now it's like 11 different demand drivers, and they're run the gamut from golf markets, military markets, mountain markets, ski markets, beach markets, university markets. My favorite is national park markets. So those markets, those submarkets in and around national parks, uh, is what's better than profiting off of our national beauty.
That's right. Yeah, absolutely. I got to see this year for the first time the Grand Canyon. So it was on my bucket list.
Yeah.
I got to drive down to the Grand Canyon this year, and I gotta tell you, it absolutely met expectations. I was blown away.
Yeah, the Grand Canyon isn't one of those things you see for the first time. You're like, I've seen bigger.
Not so grand. Yeah, an all right canyon.
Yeah. You're like,
And
oh,
they,
this is why they called it grand.
yeah, 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 exactly. And I'm a photographer, and I try to take photos, and you can't even capture it.
Yeah,
It's
you can't
impossible.
do it justice.
No, never. Well, um, looks like we're just a couple minutes past the hour. We've got over 500 people in and climbing. Jamie Lane, let's get started.
Awesome. So we're gonna I'll actually start with one of the first questions. There will be a recording of this afterwards for everyone that signed up. So don't worry about taking notes. There will also be a the deck that I present will be available. I can't do anything without a deck. Apparently, that's one of my downfalls is I've got to have a deck for everything. So I do have slides to share, which are going to walk us through. We're going to start with the methodology. We're going to talk about some U.S. performance and what we're seeing in terms of the investment environment. We'll then go through the results of our BPTI 2026. And then we'll do a demo, and I'll show you guys in our platform how to find your own best market to invest and evaluate investment properties.
And
And I've got some Easter eggs in for everyone. We've got some big product releases coming for AirDNA in the next, I think we're rolling it out over the next 2 weeks. And so I'm going to give you some views of some enhancements coming to AirDNA as we speak. So, uh, touching first on methodology for BPTI, our best places to invest. We have not changed our methodology for 2026. It is the same as we did for 2025, though we have added some new breakdowns of data. So when we talk about best places to invest, we start with investability. So we are looking at essentially gross yield, looking and we are starting just overall of all properties available for sale in the US today. So we get that from aggregated data across all the MLSs. So we're looking at there's roughly 500,000 properties in the US available for sale today. We are running a rentalizer estimate across every one of those properties. So rentalizers are a tool for evaluating the earning potential of a short-term rental. So we're taking each of those for sale homes. We're going out and finding the nearby comparable properties. So location, bedroom count, price tier, and then we're calculating a gross yield. So what is the property's annual revenue potential divided by the list price? And that is the core of this. That is our investability metric. But that's not all that we use. In our core list, we're also looking at demand and demand growth. So, what is overall occupancy? Are more properties getting booked in that market this year than last? And also revenue growth. So, looking at year over year change in RevPAR. So, is this market, are listings in that market expanding the revenue they can earn, or is it contracting? And I don't know about you, Luke, but I love to invest in markets where people are earning more money this year than last, as opposed to where earnings are contracting over time.
That is a pretty good sound strategy, Jamie.
It also, and it's not just a sound strategy. It's also helps in terms of underwriting. If you are in a market that is expanding revenue, I feel very confident in using trailing 12-month revenue to make that estimate. If we're in a market where it's contracting, that using last 12 months revenue might be a bit too optimistic if that could continue contracting in the future. So briefly showing what those gross yield metrics are, since they are so important and are going to be themes throughout the presentation today. So showing on our property cards, this is in AirDNA. Gross yield is the revenue divided by price. For every for sale listing, we're going to give the listed price. This data is updated daily, so any changes in price are reflected in the platform. We then show you what our revenue potential is for that property. And then you divide the revenue potential by the price and you get the yield. So 10.4% here. Now, touching briefly, and I'm going to go through these quickly in terms of the investment environment today. These next two slides, I think, encapsulate what we're seeing. So starting with revenue, average monthly revenue, trailing 12-month revenue in light blue. So what we see here is the trend over the past 6 years and what our expectations are going forward. You see how much revenue, average revenue really increased in 2021 into 2022 as demand for short-term rentals around the pandemic really increased. And then the contraction in short-term rental revenue. This wasn't because demand was contracting. It was because supply was being added at such a strong clip. It was outpacing demand growth and caused occupancy and ADR declines. We've now very much stabilized in 2024 and 2025. We've now are back to growth levels in 2025, and we expect that to continue. The dark blue line is the other side of the equation of revenue. It's essentially the expense of buying and financing a short-term rental. So it includes in this number what is the average home price and in any given month, what is the cost to finance a new property in that month. And there we're showing it as a average monthly payment. So what would the average monthly payment to be to buy an average home in that period? And then the premium, STR premium, is essentially the difference between the two. So what are the revenues that you could earn subtracting the cost to buy and finance that home? And you see here and what that premium looks like. We are now at the highest levels we've seen since 2023. I got down to very low levels in 2024 and 2025. And then on a level basis, we are and roughly back where we were in 2019. But that's with a big caveat of home values have gone up a lot. So if we take that premium, divide it by the cost of investment, and we get, I would call like a pseudo yield metric, and that's in green bar. So investment returns, right now we're looking at about on average about a 10%. We got down to a low of 2.8% in December of 2023. And that compares to pre-pandemic, we were running at about 15%. We've also overlaid supply growth. This is an important measure to keep an eye on going forward. We have been at very low levels of supply, reflecting and the very low levels of investment return. And we do see that they uh, sort of supply lags investment by about 12 to 18 months. So you see here investment returns peaked in the summer of 2021. We didn't see a supply peak until really the fall and winter of 2022. Now we saw investment returns hit a trough in the end of 2023. And now I suspect we're seeing the trough and the low point of supply growth in the summer of 2025. Now we have seen investment returns gaining. I do see that as a forward indicator of where we expect supply to go. And why is supply growing? It's because everyone on this call, we had over 2,000 people register that were all starting to get more interested in investing in short-term rentals today. We are seeing more investments pencil or make sense in terms of after we underwriting that they could be decent investments. And we expect that to start to play into industry dynamics going forward with more and more people investing. And that is our forecast. So we expect sometime really for the first time in a while that more coastal and mountain markets are going to make more sense and then we're going to be adding supply. And a big piece of that is not only interest rates coming down, but it's also home values and reverting a bit, coming down. We've also got the big, beautiful bill, 100% depreciation back for short-term rentals in the US, which can make the tax advantages of short-term rental investing more attractive as well. Please talk with your financial advisor. We also surveyed people. So we did a survey in late 2025. This is going to come out in the next few weeks. So keep an eye out for that. We've got a great report sort of digging into investor sentiment for short-term rental investors. And you see here it's very bifurcated. There was about 25% of you that said it's very unlikely that I'm going to invest in 2026. But there was also another 30% and add on top of that another 15% that are likely. Those saying they were looking at investing. And we have sort of turned the tide where there's more people likely or very likely to invest over the next 12 months than there are unlikely or very unlikely. And then, and we also asked about what are your constraints? And we are able to segment this by the size of the investor. And what I thought was really interesting here is one for property prices. It was those investors, both new in terms of timing, and they're 1 to 2 years in terms of their investment journey, as well as the number of properties that they have. Property prices are much more of a concern for them than some of the more experienced investors with more inventory. But also, what is most worrisome for those investors that have more and more listings is what's happening on the regulatory front. So regulations have been a concern for short-term rentals in many markets, not just in the US, but around the world. And staying on top of regulations in your local market, as well as the markets you're interested in investing in, is key. Because regulation can very quickly make a great investment into a bad one by changing the use cases around the assets you're investing in. And then the last slide from the survey, and I do hope everyone checks it out, is just and some of the other differences that we saw among different types of investors by size. Most first property investors are using traditional 30-year mortgages. But as we push into some of the larger owner operators, we do see much more creativity in terms of their financing and expanding the ways that they're getting their properties financed. So next, we're going to dig into the results of BPTI. I'm going to start with the overall list. So this is where we took into account investability, revenue growth, demand. We limit it to top 10 markets. And why we limited it is we're also going to be digging into the top markets to invest in by price point, as well as demand drivers. So we've got where before we were talking about maybe just an overall list of the top 25. Now I've actually got, and what is it, 18, 19, 20 different lists to show you. We're not going to go through every one. I've sort of cherry picked a few. The report is now live on our website if you want to dig further into all the different lists. But without further ado, we're going to run through the top 10, starting with 6 through 10. Um, so you'll see a theme throughout, and it's been consistent really the past 3 to 4 years, is that small and mid-sized cities have been showing the strongest investment returns for investors today. And that has actually shown up if you go back and look um, at supply growth in 2025. We saw 9% growth in small and mid-sized cities, where coastal and mountain markets growth of new listings and overall listings was pretty anemic, less than 4%. So no surprise that this list continues to include a lot of small and mid-sized cities. In our top five, so we've got Springfield, Illinois, Charleston, West Virginia, St. Paul, Minnesota, Abilene, Texas, and Port Arthur, Texas. Two Texas markets in our top 10. I don't think we've had that before. One of the themes I saw with these top two is it's not necessarily the leisure trend that's causing more interest in these markets and more stays. It's what's happening on the industry side. So Abilene, Texas is ground zero for AI investment today. That is where Project Stargate is being built. And there is a ton of workers, a ton of investment coming into that area to not only because of the data center build, but because of all the companies that want to be around those data centers. So we saw a 49% increase in RevPAR change over the past year. If you Google this market, headline you're going to see is that hotel occupancies were also up 30%. So massive influx of lodging demand. And then Port Arthur, Texas is really big for oil and gas, but also on the coast, driving leisure demand as well. So all of these markets, a good mix of different demand drivers. So what's bringing people into those markets, making it very resilient for investment. And also all of these relatively low price points in terms of dollar value needed to invest in these markets for homes. Uh, we did then break out different markets by different budgets. So properties between and 1 million to 5 million, 700,000 to 1 million. What you'll see as we go down through this list is homes at the higher price points typically have lower overall yields. And this is not a surprise. It's expected. We've seen this through just about every cycle. And how to think about this is if you're looking at overall investment and trying to generate cash flow and the amount of cash flow that you're going to be able to generate, if you're buying in $200,000 and $300,000 homes, even though they might have decent returns and cash flow on a relative basis, it may take three, four, five homes to generate the same amount of overall cash flow as a higher dollar value home. So we do see a decent investment returns and opportunities across all price points. And that's where it can really be in your strategy and what you're looking to get out of your short-term rental investment can drive what markets you're looking at. So top, when we look at over 1 million, we actually had quite a few large metros show up there. Washington, D.C., San Diego, Miami. When we looked at just below a million, we actually had some great leisure destination markets show up. So Santa Rosa, Rosemary Beach, which is the 30A region in the panhandle of Florida, one of the top markets there, the Ozark Mountains, Fort Lauderdale, Long Island, sort of getting out to towards the Hamptons, and then Gatlinburg, Pigeon Forge, one of the most and uh, uh, exciting or competitive investment markets out there. In Gothenburg, we have seen home values coming down, which have increased the yields there as revenues have maintained. Looking at sort of mid-tier budgets, we see areas in the southeast, Athens, Georgia, one of our top university markets, Lake Norman, North Carolina, a very high ADR market outside of Charlotte, Grand Rapids, Michigan, showing up there, Rocky Mountain National Park, one of my favorite national park markets. We also have Destin, Fort Walton Beach showing up in the 400 to 500K range, Lower Hudson Valley. Right near 30A with Destin. But when you look at homes at slightly lower price point, we actually see significantly stronger yields in a similar area. And then Pocono Mountains, another good one at that price point at 11.7% yield. The last more budget markets, you do see what some of our top markets showing up here too. Abilene, number two at the 250K to 400K budget. Burlington, Kentucky, Savannah, Georgia. Some of these markets, I like Savannah, more difficult because of regulation to get into in the city center, but maybe some opportunities outside of the core of the city of Savannah. And then where homes are also going to be more affordable. And then also at the lower end, we've got Finger Lakes, Jackson, Mississippi, and then Montgomery, Alabama. Now, that was the entirety of what we did last year. This year, now we've also looked at demand drivers. So, as I said, we highlighted 11 different demand drivers. These are them. I picked out four to show you the results on, but all of them are available on our site now, and you can dig into each of them. What you can also do, and I'll show you this in the demo in a second, is these demand drivers are now filters in our app for you to find submarkets to invest in to be able to see what the yields are, top yields, what and number of properties for sale in each of these markets, and then like what are the top ski markets in terms of occupancy, ADR, things like that. So I did start with ski. And what you'll notice is none of the West Coast ski markets or Western mountain markets, Rocky Mountain markets showed up as top on the list. We did see Poconos show up as number one, average yield of 15% here. We saw Ostego Lake in Michigan show up as number two. So that's a Bittersweet Resort, Treetops Resort, that is the ski resorts there. And then Cortland, New York, near Green Peak Mountain Resort, driving top three. On university markets, these are some of the markets and some markets I really love to sort of understand and all of the different demand drivers that you have coming into university areas. So not only is it students and football games, commencement ceremonies, things like that, but you also have the parents of students sort of coming to visit. You have university hospitals driving demand for both doctors, nurses, and patients. You have professors, grad students coming for and 2 or 3 months at a time that can drive a lot of demand. So these can be very dynamic markets in terms of year-round demand, not just around football games or basketball games. But what's great about those games is they can drive peak pricing, and a lot of profits can be driven during those periods. Winery markets is another interesting one. sort of the mix of the outdoors and alcohol, what could be better. But you see Geneva, New York, with the core Finger Lakes wine region along Seneca Lake there. You've got Wright City, Missouri. Never heard of the Missouri wine region, but they do exist, as well as Michigan as well. Um, Military markets is another interesting one of driving more midterm stay demand. Uh, Laughlin Air Force Base near San Antonio, Fort Jackson near Columbia, South Carolina. Columbia was one of our near the top of the list, and Fort Jackson, Fort Moore, Shaw Air Force Base, all driving significant demand into these areas. And it's not only from military members, but their families looking for more long-term housing. And then also a lot of the suppliers to military bases and going down for meetings, going down for extended periods of time and needing temporary housing. So those can also be very dynamic in terms of amount of demand that's driven. So with that, maybe wanted to pause for just a minute, Luke, and see if you've got any questions for me about the list.
Yeah, absolutely. I think one question that I see pop up a couple times is if the markets mentioned have friendly short-term rental regulations.
Yeah. So what we did on the list both this year and in past is when you go and look at the lists in the write-ups for each of these markets, and for every single one of these markets, we did do a write-up of what are the interesting pieces of these markets, and then we highlighted anything you know around need to know around regulation. Um, so we did exclude any markets where short-term rental investment is explicitly banned, but did include markets where there's just some hoops you need to jump through to be able to invest in those areas. So maybe getting your property registered, paying a processing fee, and things like that.
Fantastic. And then a couple of different kind of market questions for you, Jamie. I'll throw two at you. You can decide which one you want to take. What are your thoughts on Henderson, Nevada, or Desert Hot Springs, California, both near golf and national parks? So we've got a couple of markets there, Henderson, Nevada, and Desert Hot Springs, California. And then we've also got South Bend. What do you attribute South Bend being the strongest university market over college towns like Athens, Ann Arbor, etc.? So choose your own
Yeah.
adventure.
And I won't comment on individual markets in terms of their investment opportunity, mostly because I don't have the data in front of me and I'd want to dig in. So I would suggest all of those markets are sort of explorable within our app. On South Bend versus others. So when we looked and created all the sublists by investment, price point, and demand driver, there we just use the investability segment of our overall methodology. So we're looking essentially ranking markets by the gross yield of every single for sale property. So what's really interesting there is because this was done off of live for sale homes, we can now go into our app. We can click on those markets and you can see the specific homes that are for sale with high yields because now we allow you to sort every single home that's for sale by its gross yield and see what are the properties driving good potential investments versus not so good. So I would definitely suggest diving in to those markets a bit more, and maybe I'll take that opportunity to dig into our demo. Um, One thing I've learned is never try to do a live demo with 1,000 people. So I am going to just walk through a few screenshots, but I think this is going to be really helpful for everyone in terms of understanding what tools are out there now to help you find better investments. So starting with filtering on markets. So we do not just have a platform that you have to put in any city name and evaluate those cities one by one. We do now have a great tool for being able to find specific markets and types of markets, and then be able to compare multiple markets against each other. So we have filters. You can filter by size of the market, market type. So whether it's a beach, suburban, small city, rural area type market. You can now search by demand drivers. So if you just want to look at submarkets that are driven by airport demand, you can one click and be able to find all those submarkets. If you want to look at just submarkets that are driven because of the ski resorts nearby, you can click on ski and be able to see that. So we do think market discovery is now getting a whole lot easier, where it's not just you need to only be looking at the sub or the market that you grew up going to or that is in your backyard, that you do have the ability to discover a whole lot more potential opportunities. Uh, you can then filter and sort these markets. So based on your price point, based on the bedrooms, bathrooms, number of guests, property type that you want to be looking at, you can filter the data down. All of these metrics now are going to be respective of filters. And then you can sort by market score, occupancy, revenue potential, average daily rate. So if you want to go to, all right, what are the top ski markets? Let's filter to 4+ bedroom homes, maybe with a hot tub, and then sort by revenue potential to see which markets might give you the best revenue potential there. That's all now just a few clicks away. And then um, I said I would mention some of the things we have coming out. We are now rolling out the ability to do heat maps by all of the key metrics. So when we go look and want to compare different markets against each other, so I filtered down to the state of Florida, selected revenue, um, and we can see a heat map of earning potential by revenue across the state of Florida. Um, and then also heat maps by submarket. So here I've zoomed into Los Angeles and I can see, okay, the Hollywood Hills down to Santa Monica, really high revenue potential, but a dearth of earnings sort of in the middle of LA, sort of Compton down to Torrance and Carson. Um, we also give you the ability to dig further in understanding what properties are generating the highest revenue and why. So I can filter to different bed baths, amenities, different combinations. I can sort the list by revenue, reviews, to see which properties are generating the most amount of revenue in any market. And then what I really love now too is that I can create different comp sets. So for any property within the app, you can click on the plus button, add it to specific comp sets, and then get the historical performance of that aggregated comp set. So you can see how specific groups of properties have been earning over time. And then we have, along with the heat maps, the ability to visualize revenue and all the other metrics on the what we call the pills or the dots that represent each short-term rental. So you can essentially get visual sort of dot heat maps of what types of properties, what properties are driving the highest revenue. Um, that's not all. You can also use these heat maps to find areas that might generate the highest investment return. So if Atlanta was one of our top markets to invest in, you could then go to this heat map. And as I said, this is going to be rolling out over the next 2 weeks, and see, okay, which submarkets have the highest overall yield potential given the homes for sale in each of these submarkets. So where it looks like there's not a lot of opportunity in maybe Roswell, Alpharetta, or Duluth, there is more investment opportunity maybe in Southeast Atlanta, near East Point, that could drive higher overall returns. And I could do this either looking aggregate at the submarket level or dig in at a property level. So now we can find specific listings that are driving those higher returns. So see each of those properties for sale with the return sort of shown on that dot, and then click through each of those properties. And then as we move around on the map, you're going to see the list on the left update with those properties that you're looking at. So where what was a in many ways a very cumbersome process of going on Zillow, finding for sale properties, then running each of those properties through our rentalizer tool. We are trying to make that whole process much simpler, where you can live in one platform, AirDNA. You can find markets that generate the highest return potential and then evaluate each of those potential investment properties all entirely within the app. Then, when you find a property you want to underwrite, you can click on it. You can see the details around the projected numbers. You can run that rentalizer report, which allows you to view now and edit all the comparable properties that were used to generate those estimates. So here we've got 10 comps or 9 comps that were used to generate this revenue projection. You can see the earnings of each one of those properties. And if you want to get rid of one, like maybe there's one property that's not as comparable as the others, you're able to click edit or just click on the trash can, get rid of that property, and then rerun the entire estimate and get a new revenue projection. So it really puts you in control of evaluating your estimates. It makes evaluating these comps all the more easier, but also more important. If you click on each one of these properties, you're going to see the amenities, you're going to see the specific location of that to make sure it's comparable with the property that you're looking to buy. And then we also have this new confidence score where it tells you on a relative basis, like how comparable and how tight these sets of comparable properties are. Like this one, we see it has a high confidence score, and we see a range of comparable properties anywhere from 35,000 to roughly 75,000. So that is a pretty tight range. Where if you get a lower confidence score, you're going to see a much wider range in terms of earnings for each of those comparable properties. And then as you edit that comp set and maybe remove some of the outliers, you're going to see the confidence score increase and move from maybe a low confidence score to a high one. And then a common question we get is, and can you break out cleaning fees if you expect those to be a pass-through expense? The answer is yes. We're now breaking that out directly in the report so you can see of the $52,000 in projected revenue, we're showing of that almost $9,000 was collected cleaning fees or other fixed expenses associated with those bookings. Um, Wrapping up, I wouldn't stop there in terms of evaluating your investment. Always and dig into the market, dig into the submarket. So if you look at the top of your rentalizer report, you're going to see the market and submarket that it's located in. So this property that we're evaluating is in Morganton in North Georgia. And then you can dig into, okay, how have occupancy levels been trending over the past year, over the past few years? What is your seasonality in terms of pricing? When am I able to get peak pricing? When am I going to have off peak? How far in advance are guests booking to help drive your revenue management strategy? So lots of additional context and information that can help inform you on your investment journey. And then the last slide I have for you is another sort of view into one of the views we're releasing over the next couple of weeks. It's one of my favorites. I had to really push the dev team for this one. And this is looking at data on guest reviews. So when every guest stay happens, the guest is leaving a review on how they and felt about the overall stay, your overall score, but they're also giving you insights on that location. Did they like the location? Did they not like the location? As investors, I think this is a key insight. And now we're giving you the ability to essentially crowdsource all those millions of guest reviews on how much people like that location or don't like the location. I've zoomed in here on San Francisco, on the peninsula, and here you can see the two different views we're allowing this to be seen. One at a property level, where you can definitely see the sort of concentration of five-star guest location reviews, both in the Mission area, but also down in Market Paradiso, San Francisco, and then maybe lower scores in Sunset District, West Portable, Ingleside, over to Bayview. And then the ability to aggregate those up into views and aggregate by submarket. So you can see the much higher reviews in the middle here in the Mission and in those other areas we sort of called out. And then, really importantly, all this is then filterable too. So if you want to just look at properties uh, with hot tubs, or look at 5 bedroom properties, or look at properties managed by professional hosts, or those just managed by individual hosts. All that data is then able to be filtered and create your own custom heat map by all the different metrics that we're allowing this to be done by. So that is coming soon. Super excited to get everyone's feedback and what maybe additional metrics you'd love to be able to visualize within the app and other ways that you'd like to visualize it. So, as I said, the report's live now on our site. You're going to see it across the top of our website if you type in just airdna.co. My email is jamie at airdna.co if you have any questions, concerns, want to dig in further. But if not, I'm happy to take questions.
All right, Jamie. I'm going to start collecting maybe a few of these into kind of some buckets. I think one big bucket, and first of all, thank you. This is amazing information.
Yeah,
Super,
I'm also looking at the list of questions, Luke, here. We've got what, over 80 questions already.
yes.
So we will clearly not get to everyone's questions, but we will try to follow up the best we can.
Yes, absolutely. I think one interesting kind of theme is around midterm rentals. I think you talked about a couple of those top markets in Port Arthur and Abilene being ones regarding like AI data centers or oil and gas, and maybe they're not staying for a quick weekend. So
Mhm.
talk about maybe midterm rentals broadly and how the AirDNA app kind of handles that when you're searching it in markets.
Yeah, so we did do a pretty substantial model improvement. So we are now, I think, very accurately capturing midterm stays within our data. And one of the ways I like to look at it to understand how much midterm rental demand, some of the charts in our market overviews, or you can look at average length of stay over time and by month. And understand on average how long people are staying there and then how that changes seasonally. And the sort of switch between months where you're driving leisure demand, which can typically be much shorter stays, to when you're more reliant on midterm stays or more non-leisure demand, that can show up in terms of higher overall length of stays, and also a way you should compare your market against others is what is that average length of stay, and maybe what is the composition of that. And I would suggest we did just publish a big report on monthly rentals and the trends that we're seeing across them with our friends at Furnish Finder. So if you Google AirDNA midterm rental analysis, you'll find that.
Fantastic. And a very simple question here. What AirDNA plan do you need to get the information you were showing? I think some questions about, do you need host? Do you need pro? Do you need advanced? What do you need?
Yeah, so everything that I was showing is available within Pro. So the ability to view, uh, um, run rentalizers, customize comps, view property performance, all of that is available in our Pro plan. Um, we are going to give you some of the heat maps in the free tier, but then those heat maps won't be filterable, or you won't be able to see the ranges until you're a paid Pro subscriber. Absolutely, and all this functionality that I've shown is going to be for all of our paid users. So great, I think, value there.
Fantastic. A few questions on for sale properties. So I think just broadly, I think if you could talk about how for sale properties work in AirDNA, some questions about, are they all short-term rentals? Where are you getting the for sale property? So if you can maybe just broadly touch on how do we kind of capture these for sale properties? And I think you talked a little bit in the presentation about how to use them, but just give us a little bit on for sale properties.
Yeah. So happy to share some on that. Maybe I'll even show some visuals there. So we partner with realtor.com to be able to pull in all of these properties. So we actually pay a lot of licensing fees to be able to and get the rights to be able to ingest this data, share it. It's not something we're scraping. This is data that we ingest on a daily basis that is inclusive of all the MLSs that are participating with that partner. So it is not every home that's available for sale, but it's the vast majority. Um, we then allow you to view those for sale properties across every market in the country. So you can view each of these properties. When you click on one, you're going to get the full sort of MLS view and the details about that property, who the broker is, property details. And then what's unique to AirDNA is we then show you for that property what is the projected monthly revenues, how have those revenues trended over the past couple of years. And then if you want to and run a full rentalizer report and be able to edit the comps, you can be able to do that directly from that report. So here I can view the comps that were used. I can view the other potential comps, maybe add this property that's nearby into the comp set, which I can just do with that, and then update the report, save it for later, download it, whatever I want to do. And then I'll always have that property saved. And I can go back to my Rentalizer dashboard and see all the past reports I've run over time.
Fantastic. While you're in the app, Jamie, got a couple questions on specific amenities. So we talked about demand drivers, but is there a way to see if adding a specific amenity would be worth the investment for a property?
Yeah, love that question. And it's a question that we get pretty often. So, how I like to do that is starting, and we can do it high level. We can do it and on a monthly revenue basis, things like that, on or looking at ADRs. But it's all based on filters. So let's say I'm in the Hiawassee market in North Georgia and I want to get the impact of maybe hot tub or no hot tub. So that's where I'd want to start with getting in a broad sort of comparable set of properties. So generally, like let's say I'm looking at a 3 bedroom property, so I can get a nice subset. Want to make sure I'm only looking at entire homes and house, so single family home properties. So I can get a good sense of, okay, the average home in this market is generating $230,000. It does look like a good number of these properties are on the water. So I don't want to include waterfront homes in this analysis. So I just want non-waterfront. So I see now my average is 214. And so now I can work with different amenities. So I said I wanted to see the impact of hot tub. So I could look for properties with a hot tub and see what my overall ADR is. I could see what my average earnings are for properties on a per year basis. And then I could then go and see, all right, what does that look like for properties with no hot tub? And this can give me a great way. Yes, it is comparing at the averages. If I was going to go in and do a more in depth analysis, I would actually probably create two different comp sets with pretty comparable properties. And then I could go into my set of comps and see, okay, I've got one comp in um, Hiawassee, 3 bedrooms, not on the water, and luxury properties with a hot tub, luxury properties without a hot tub, and see, then look at the performance and be able to see the average earnings. Like, all right, is it that these properties are getting higher ADRs? Is it because they're getting higher occupancy? And you can sort of start to explain what the difference is in earnings because of those amenities.
Super. Once again, just noting, because I think some folks joined late, this all will be available. We will send out the deck. We will send out the recording of this webinar to folks. Um, and Jamie, maybe one more question here, and then if there's anything you want to tackle, please do. But I think people are really excited about yield. Can you just one more time just talk about how is yield calculated? Does it take into account occupancy? Ultimately, how is yield calculated and why is that metric so important?
Yep. So yield is one of my favorites metrics for doing sort of the top level filter in terms of potential investments. Uh, it takes into account and at the base what the property's for, available for in terms of price, and then really importantly this revenue metric. So this revenue metric is the aggregate of both what is the expected occupancy for this property, what is the expected ADR of this property, and then we're taking those and projecting the revenue that this property is going to earn if it was operating for a full 365 days over the year. So this is taking to and using all the comparables, sort of the nearby properties, to estimate what this revenue is. And then the yield is just then a function of what is this projected revenue divided by the purchase price. Um, and what this allows us to do is sort of is a to have a more comparable view of evaluating potential investments. Because if we're just looking at home values, I'd say like, oh man, there's $1 million homes down here. There's $600,000 homes here, $825 home, $25,000 homes there. Like, and that's not super helpful for knowing if it's going to be a good investment. And you could also go and just look at the revenue potential of each of these homes. And like, oh wow, this property is going to make $36,000. This one's going to make $47,000. Like, is that good or bad? Like, I don't necessarily know. But by combining those two into looking at the yield, now I can like, all right, like on a relative basis, that home value of $640,000 and a revenue potential of $44,000, like that gives me the highest overall potential yield for properties available in that area. Now let me dig in further. Um, and what I would do next is go through the entire calculator of looking at and what are my fees going to be, what are my expenses going to be, and calculating like, am I going to have a positive cash flow from this investment? But in terms of initial filters, I love sort of using yield for that. And what we do within AirDNA is you can now sort for any market that you're in all these homes based on yield. So the highest yield properties are going to show up at the top. And you could also sort by newest or price, high to low. And then you can also use yield as a filter. So let's say, um, Luke, like you're sort of an investment snob and you're like, yeah, I only look at properties at greater than a 10% yield. I would never even waste my time looking at anything lower. Now, when you go into the map, you're only going to see properties that sort of meet your investment criteria. And that's what I see these filters of as letting me build my buy box of, okay, I'm looking at properties greater than $400,000. I really want to invest in homes that are 4 to 8 bedrooms. Um, and maybe I want to exclude any properties that aren't zoned for short term rentals. Um, and now I can visualize all those properties on a map at once and see what's going to be a good investment for me. So it can really make finding good investments significantly easier than it was.
I think that's something that it's actually kind of a common theme with like a lot of very specific questions that we often get in these webinars is, hey, for me, I'm trying to do exactly this. And AirDNA is built to help you, for you, build that buy box, like you said, and find the property that makes sense for you. For a lot of people, it's I want to be within a 4 hour radius of where I live and I want to stay there sometimes. And for some people, is this is a straight up, I just want to make as much profit as I possibly can, and I'm pretty open to where it is. So lots of different kind of intents when you're looking to buy a short-term rental. And thanks for showing how AirDNA can be used to build that buy box.
Awesome.
All right, Jamie. Well, we got just a couple minutes left. I think that is going to be it. Any final words?
I just say I'm really excited about 2026 for both on the investment side. I think there's going to be a lot of opportunities for short-term rental investors. If you need help on how to get started, on how to evaluate markets, I think AirDNA's got a lot of resources for you. We've put a lot of time and effort into um, um, uh, our blog and providing resources for you on how to find and evaluate markets. We do monthly reviews every month on what's happening in terms of short term rental performance. So, my colleague Bram Gallagher gives an amazing review of short term rentals. And this, if you are looking at investing, keeping an update on what's happening in terms of supply, demand, like is supply trending up like Jamie said it was, or was he entirely off and it's trending back down, or it's gone negative and no one's investing in short-term rentals? Like you can dig into those on a monthly basis. They're free. And then I'd also highly suggest everyone subscribe, listen to the STR Data Lab. We have a weekly podcast where we interview top investors. We talk about the economy and how it's impacting short term rentals. We've got an episode going out, I think, tomorrow on our best places to invest list with my colleague Scott Sage, where we dig into our favorite markets. And then I've got an amazing interview going out next week with Steve Schwab, the CEO of Casago and Vacasa, the largest operator of short-term rentals in the country, and really some amazing insights from Steve on what he's focused on for 2026 and how he thinks property managers can really and stand out from the competition and drive additional returns. So amazing insights from Steve coming out next week.
Fantastic. Well, thank you very, very much, Jamie. Thank you, everyone, for attending this year's Best Places to Invest webinar. Keep an eye out for the recording. Keep an eye out for the reports. They all should have fired off about the beginning of this show. So thank you so much for joining, and we'll see you on the next one.
Bye, everyone.
Bye.